Okay, greetings traders. In this video, we'll be looking at the latest addition to our suite of NinjaTrader tools and indicators. This is our dynamic reversal zone indicator. Now here I have a 2-minute MNQ chart with the DRZ indicator applied to the chart. Additionally, you'll note at the bottom here I have a 200 EMA on the chart for a bit of trend bias. Now, I'm using market replay of the last week. I'm recording this on December 22nd, so I've gone back to the prior week, Monday, December 16th, and we'll use the replay to show some examples of this in action. Now, there's a clear logic as to why a trader might look for an entry in these retracement or reversal zones. So let's just dive into that. So I'm just with a quick review here of via line drawing here. We can make some assumptions here based on this price action. Now, of course, you'll note here on the left-hand side that the market is doing exactly what I'm depicting here in this line drawing. Here we get a swing, we get a retrace, swing, retrace, swing, retrace, right? So this is just basic trending in the market here. It's not, I wouldn't call this theory. It's reality of how the market moves when it's trending, right? We swing, retrace, swing, retrace. With each of these swing highs being broken, we get a break of structure, and we know from market structure theory and from a lot of observation and application that after a break of structure we can anticipate a retrace. It's healthy for the trend actually, and often you can think of it as the market's in a trend. It's got to refuel, so it will retrace to pick up liquidity and then carry on in the trend. So as we look at it here, we can make some assumptions about this price action that creates the retracement zone. And with that, we can look at this pivot here, what currently now in hindsight we know is the weak high. But we know that if the market is moving higher, we get a pivot here. Money has to be committed here to create the retrace, right, and to stop the uptrend. So short sellers here have committed thus to create that downtrend. When we get to the pivot low, well, of course, again here, just the reverse of that has to be applied, right? Money has to be committed here to stop the downtrend. And ultimately, there's enough strength here, enough buying demand here to break the prior high, and thus we get a strong low and a weak high. So it's just continuing on in that theory. This becomes a protected low. This is a weak high. So as we move on here, if we look at just in the application here, now here, we don't know that that's going to become a weak high, right? All we know is that the market has started retracing from this high. Now, it's very, very common, and in fact, you see it over here on the left. It's very common for the market to retrace right to the edge of that retracement zone. This is the a la previous resistance becomes support. But if we dig a little deeper into that, we can make some assumptions about why that's happening. So first, if we start to retrace here, there's a couple things that may be at play here. The short sellers here that didn't exit on the break here may very well be looking to this pivot here as we return here to let me get out at break even here. If the market digs a little bit deeper, if they stayed with that short, now all of a sudden they're seeing a little green, right? So they may bring their stops down a little bit further here, saying, oh, hey, maybe this is going to turn into a winning trade. That's one possibility. The other here is that those that were long here, well, if it was size, it's very possible there were unfilled orders here in the midst of this, so there could be limit orders sitting in the book that are just waiting to get filled as the market retraces back into this zone. And then additionally, it may very well be that bulls here are defending those longs as we come back into this retracement zone, looking to push the market on, carry on in this trend, and then eventually break that high, and then we'd get another strong low here and a weak high, and that series would just continue. Where there's opportunity here, and again, you will certainly want to backtest this to confirm it rather than just look at a video like this. You want to go through this process yourself, and that's part of what we're doing here with this market replay, is to show you that this can be a very effective way to enter the market. Now, as we look at it here, the other possibility here, because we don't want to forget about the traditional fib retracement theory here that we've been discussing here for many years here. So this retracement here, it may very well be additionally traders that are looking at the entire swing structure here. So from the low, even though we have this here on a higher time frame, maybe this is a 1 or a 2 minute here, and we're looking at a 10 or a 15. If we start a retracement here, this retracement here could very well be just a traditional or contemporary, let's use that term, contemporary measured move, right? So we get the entire swing structure here retracing, now coming between the 50 and the golden zone, coming back in here, and you might anticipate that there's going to be some algorithmic activity here as well as the market goes through a larger retracement here, again, contemporary measured move, with a target up here at the negative 23.6. That's something we've advocated as a very consistent algorithm in the market. You see it all over the place. So that's how these theories can align, and you can get some confluence of technique here. There may also very well be some displacement or a fair value gap. Here you see a fair value gap is part of what creates the reaction here. So all of this can be in play, but if we just come back to try and simplify this, let me get this off of here. Where we want to focus with this indicator is what's happening in that retracement zone here. Now, to make it relatively simple here, you could just put the 50, because the advantage of the 50 is that we get a perfect one-to-one kind of trade, right? So if you're entering at the 50, let me get it right on there. And this is a very reasonable approach to this. If you're entering right at the 50 with the anticipation the trend will continue, well, your first target could just be a scalp target. We're going to go from the 50 to the pivot high, right? We'd get a true one-to-one stop under the low. First target, right? It could be just a scalp target, right? I don't want to discourage that. You could just scalp this, looking for that as your first entry. If you have, again, based on the what's happening in the market and your analysis of where you are in that trend, this may be something where you're anticipating a move to that high. Oh, perhaps you've got a point of interest up here that you're targeting, so anticipating that it's going that direction. You don't necessarily need to exit here, but that's not a bad way to approach this with a scalp target out here, maybe another here at the high, right? If that's a high, you know there's going to be liquidity there, and perhaps you've got a higher target. But the point here for us is looking for the entry here. Now, the simplest way to do is just enter at the 50 and maintain that one-to-one, but often you'll see the market won't make it that deep. It may just come in here and tap a toe, right? You may miss it. This is just a fib zone here, so 382, 50, and 618. That's a reasonable way to look at, so you fatten the target a little bit. Now, if you're entering, of course, at the 382, you're going to lose that perfect one-to-one on your risk reward, so do the math there accordingly. Make sure that's not more risk than that's appropriate for your account. But that's the idea here. When we come into this zone, we know that there's been a battle between bulls and bears here, and there's very likely to be ongoing activity as those are reconciled here, whether shorts are getting out, longs are defending, right? All of the scenarios we talked about here. So that's the theory behind this. Now let's take this to the market and look at a few examples and let you decide whether or not you think this would be a valuable addition to your arsenal of technical analysis tools. Okay, let's take a look at it.